Institutions bought $3.8 billion worth of Bitcoin through ETFs in November, then pulled it all back out in the same month. BlackRock's Bitcoin ETF shed $2.47 billion. Fidelity pulled another $1.09 billion. Together, those two names accounted for 91% of the outflows. The people who bought Bitcoin after seeing those inflows? They're now selling at a loss. The pattern reveals something uncomfortable about what institutional adoption actually means for Bitcoin's path to a 10x return. Bitcoin sits at roughly $1.5 trillion in market capitalization today. A 10x from here means reaching $15 trillion, 60% of gold's total value. Gold took thousands of years to achieve its $25 trillion market cap through jewelry, central bank reserves, and industrial use. Bitcoin would need to absorb that same level of conviction in a fraction of the time, with a tenth of the use cases. The math gets harder when you realize who needs to provide that $13.5 trillion in new capital. Retail investors moved Bitcoin from $0 to $1 trillion over a decade. Institutions took it from $1 trillion to $1.5 trillion in 2 years, but they did it with leverage, ETFs, and structured products that can reverse just as quickly. Recent holders sold $770 million in Bitcoin at a loss in a single day when the price dropped to $76,500. Those aren't long-term believers exiting, they're people who bought after institutional adoption made headlines. The mechanism creating this trap is simple: institutional money is fast money. When BlackRock's ETF sees inflows, it's not because asset managers suddenly believe in Bitcoin's monetary revolution, it's because clients want exposure and advisors need to allocate. When macro conditions shift, when treasury yields spike, when liquidity tightens, that same capital exits without ceremony. The ETF structure makes it effortless: click a button, liquidate the position, move to bonds. No friction, no loyalty, no conviction. Retail investors who bought Bitcoin in the $90,000 to $100,000 range, many of them reading stories about institutional validation, are now underwater. Some watched BlackRock buy and assumed the bottom was secure. The Florida man who read the Bitcoin Standard and went all in on Bitcoin at recent prices isn't wrong about the theory, he's wrong about the timeline. If institutions can inject $4 billion in a month and then pull it out just as fast, Bitcoin's price becomes a function of their tactical positioning, not its fundamental case as digital gold. Gold's market cap grew slowly because it had to convince billions of individuals, one transaction at a time, that it was worth holding. Bitcoin is trying to skip that process by attracting institutional allocators who manage other people's money and optimize for quarterly performance. The result: Bitcoin now needs to convince institutions to hold through volatility, something they are structurally designed not to do, or it needs to rebuild the slow, grinding path of individual adoption that doesn't show up in headlines. A 10x from here isn't impossible. But it requires $13.5 trillion in committed capital flowing into an asset that institutions are proving they'll abandon the moment it tests their risk models. The people selling at a loss today believed institutional adoption meant stability. What they're learning is that institutional adoption means liquidity, in both directions. And liquidity, when it flows out faster than it came in, looks a lot like a trap for anyone who bought the promise without understanding the structure.